Make large crypto trades with Kraken OTC, execute orders of more than 100,000 off the open exchange through our premium OTC trading service. Get 24/7 access to deep liquidity, minimal slippage, and competitive execution and settlement services. Private and secure trading options include chatting securely with our trade desk for a personalized high-touch service, or use our self-service RFQ for super fast, automated OTC trading. Non-investment advice. Crypto trading involves risk of loss and is offered to U.S. customers through Payward Interactive Inc. For more information, go to realvision.com/Kraken OTC.
Hey everyone, look, sorry, this is the cheesy interruption that you get on YouTube channels, but they're really important. I'd really appreciate it if you just hit the subscribe button. You see, it makes a difference to know how I'm doing, seeing the growth in subscribers, if we're getting the right content. Obviously, comments help as well. But hitting the subscribe button allows me also to book the best guests. It really does make a difference. So if you do enjoy this content, and I know you do because you keep coming back to watch it, just please hit the subscribe button. Sorry again for the cheese, but it is important. I appreciate it so much. Take care.
Hi, I'm Raoul Pal, and welcome to my show, The Journeyman, where I travel with you to that nexus of macro, crypto, and the exponential age of technology. I have been in the hedge fund industry for 30 odd years now. I've both sold to hedge funds. Many of my friends are hedge funds. I've run a hedge fund. And so they're dear to my heart. I even have an asset management company called Exponential Age Asset Management, XPAM, which invests in crypto hedge funds. You see, my thesis, it's a fund of funds. My thesis is that if you really want to capture the performance of this space in crypto as it goes from $2 trillion to $100 trillion, you're not going to get it all by being just in Bitcoin, Ethereum, or Solana. You're going to have to figure out what the next big breakouts are, where the big gains can be made, where's the next 100x. And that is incredibly complicated with the thousands of tokens that exist and tens of thousands of memes and all the other stuff in the space. You kind of need to rent it to experts. And these hedge funds are the experts. Now, what's interesting about the hedge fund industry in crypto for me is it's incredibly small. Versus the VC industry, it's about a fifth or less of the size, maybe a tenth of the size of the VC industry. There's actually not a lot of secondary market professional participants in crypto, which makes it very, very inefficient, which means it can be very profitable. So hedge funds can make supernormal returns. They focus all day, every day, 24 hours a day, 7 days a week because it's crypto, on doing this. In traditional markets, there's about $4 trillion in hedge funds. In crypto market, it's about $10 billion, i.e. nothing. The big players who push prices around, some people would say the more manipulative players, tend to be the kind of private trading shops out of Asia. They're very big in the space. Then there's the market-making firms, people like, Jump Capital, who are now moving out of the space. But there are other market-making firms. And then there's some hedge funds, but a lot of retail. As retail investors, we got to front run a lot of the money coming into the space. And that's been the gift that keeps on giving in crypto, is being ahead of Wall Street for once. But there is a group of hedge fund managers who really are fabulous because they understand this market. It's super depth. Their job is to find the big trades. And one of my favorite managers, and as a disclosure, XPAM is invested in DACM, Richard Galvin's firm, is Richard Galvin. He grew up as a TMT analyst over the tech years. He understands the technology deeply, and he runs a very large hedge fund in the space, but he's also just a brilliant thinker. And I love to sit down with Richard from time to time, pick his brains, where we are, what's going on, and what we should think about. So I really hope you enjoy this conversation with Richard Galvin. Now, before you go, I do urge you to pop over to the Real Vision platform, because a conversation like this is long form. There's going to be a lot of information for you. If you're on realvision.com, which is free to join, you can then use the AI summary that's already there once you come on, the transcript. You can clip it into your own AI or the Real Vision AI that's on platform that will help you summarize. You can search for the keywords so you can understand. And also, if there's a great trade idea, you can post that trade idea on Real Vision, either privately for yourself, and it populates the P&L to show you how you're doing, or you can make it public and share it with others so people can see your ideas too, comment on it, like it, that kind of stuff. There's a lot going on the Real Vision platform. There's a lot of crypto content there that's not on this channel. So go to realvision.com and see if you can watch this interview there, because I think you'll absolutely be blown away by the experience. Anyway, let's speak to Richard. Join me, Raoul Pal, as I go on a journey of discovery through the macro, crypto, and exponential age landscapes. In The Journeyman, I talk to the smartest people in the world so we can all become smarter together. Richard Galvin, how the devil are you?
I'm okay. We live in very interesting times.
Yeah, listen, before we get cracking into all of this, just for some people who don't know you, give a bit of your background, what you do now, just to frame up our conversation.
Sure. I was a banker for 20 years, largely a TMT, so tech and telco banker at Goldman and JP Morgan, and started a crypto investment management firm, DACM, back in early 2017. So we've been running institutional family office capital through the crypto space for 6 years now, and we're an investor, so we run sort of long only and VC strategies. So we're long the market, looking to play the growth, or the long-term trajectory growth we see over multi-decade growth in this asset class.
And for people who don't know, DACM is one of the larger crypto hedge funds and one of the longer established ones as well.
Yeah, so we run around about 450 million of outside capital.
So look, we're recording this on a Monday. It's Tuesday morning for you, Monday evening for me. This won't go out till Thursday. So, we can't talk particularly, in granularity. But what's your take on what's going on in the markets right now? Because it's actually been a pretty crappy market for a while, sideways, sloppy, corrective pattern. What's your take on the overall market for now before we dig into some more stuff?
Yeah, I think one of the interesting things we've kind of seen, this is probably the second or third time crypto's kind of acted a little bit like a canary in the coal mine. So, as you mentioned, crypto's been weak for the last 6 or 7 weeks, right? So it's kind of in a way been ahead of what we've seen over the last 24 hours in traditional markets. And to be honest, we kind of saw this back in 2022 as well, where crypto was kind of weak well before we saw traditional markets kind of fall over. I think we've been in, and we can talk a little bit about this later on as well. I think putting aside the sort of the short-term market factors we can talk about, also I think there's been some structural issues in crypto over the last 6 to 12 months, and we've got a substantial mismatch between the capital that's in the pre-listing or VC market versus the capital that's in the listed market, and we've seen that play out particularly around the altcoin space. And then on top of that, you've seen the ETF launches, which has driven incredible capital inflows, but very much focused at that Bitcoin and now on the Ethereum level. And then at the other end of the barbell, you've got the meme coin kind of mania. So you're in you've seen some pretty different sort of structural flows in the way the capital's been allocated across crypto than we've seen probably in the last sort of 6 years before that.
So let's talk about just how you're navigating the current volatility, because you've been through plenty of volatility in the past. You're a long only guy, so this is all part of the game. You come in you're looking like we all were over the weekend and everything turns to shit. What do you do? How do you think about it? What discussions do you have internally?
Yeah, I think we've found that we've been rewarded over the journey for being patient. And I think the crypto market, one thing it definitely doesn't have is patience. So we generally try to stick to kind of our knitting through these sorts of periods and make sure we battle test the portfolio and everything that we own, continue to sort of test that we own it for the right reasons. And clearly owning assets in this market for momentum-based reasons when something like this happens can be a disaster. So we're very much focused around what we'd say is that sort of fundamental end of the crypto market, assets that we see can ride through this volatility and prosper on the other side. And I guess a period like this is just a chance for us to sort of retest the thesis on what we own and retest the data and the data and the statistics we follow to sort of get an update on the assets and check that everything's still in line with what we think. And then really our approach has been long only, and we're 80% plus long in our liquid strategies through these periods, is then just to hold our nerves. Now, we've found through the journey, crypto, the biggest mistakes people make in crypto generally happen right at the top of the market and right at the bottom of the market. So we're very disciplined on making sure that we don't panic in these types of periods, just like we try not to get too euphoric on the other side of the coin as well when things go our way. And I've found sort of over these sort of 6 to 7 years, that's the period where you've really got to focus and stick to your strategy in your allocation process and make sure you don't deviate from that. Because it's hard not to get caught up in this.
Yeah, that's right. And how do you know what market phase you're in? Because that's what I find gives me the comfort is like, where are we in the market structural phase, in the cyclical elements of this? How do you think about that when it comes to testing? So you'll test your individual tokens, have we got the right stuff? Do we still believe in the thesis? But then there's the market question, are we just stupid? What are we testing against? What do you use as kind of metrics to measure where we are?
Yeah, I think when we start with the macro tailwind, I think you'd agree with what got that we're owning digital assets going through digital revolution. So, the longer you sort of zoom out, the more comfortable you get that you're in the right place. Now, as you start to get onto smaller timeframes, you start to get into the questions you're asking around where we are in that specific cycle, as opposed to that sort of structural, sort of societal change I think we're going through over the next 10 to 15 years, which is definitely in our favour. So where we're at in the cycle, I think we try not to rely too much on the individual sort of cycle maps. They've been, when you look back, they've actually been pretty strong in crypto, but it's always a risk that things change. And I think, to be honest, if we look at sort of 2023, 2024, it's a little similar to sort of 2019, 2020, but it is pretty different. And the portfolio constructs we've used have been a little different in that regard. I think we've seen a skew much more towards the majors than we would have seen if we tried to track it back to the previous cycle. And that's probably partly been driven by the ETF as well. But we also have seen crypto sort of revert back to its somewhat uncorrelated sort of behavior, which I think is generally our assumption of the steady state, that in a normal market where TradFi is either not going crazy exponential up or down, crypto kind of does its own thing. And that's probably what we've seen over the last 6 to 9 months. Periods like yesterday where you start to see substantial volatility, that's when the correlations start to come back to normal.
And do you hold cash ever for times like this? So you've got flexibility to add when you get, great prices again?
Yeah, so we run up to 80%. We're 80% long. Through the journey, we've probably been sort of low 90%. And we'd actually built up close to 20% cash up through sort of June into and ahead of the sort of the crash in July. We deployed most of that capital in early July where the market fell 20% in sort of 5 days, which is sort of similar levels to it's got to today. We do that. Look, we take a view that when you sort of zoom out from a macro level, if you're in an asset class that's got exponential growth potential over a 10 to 15 year time period, the last thing you want to do is shoot yourself in the foot for it by being in and out of that asset class at the wrong time. And the other factor to consider is crypto returns and losses come in very concentrated periods. So you could be out of the market for only 3 or 4 days each year, and you can dramatically reduce the returns that you get over a 5 to 10 year period in crypto, because they're the 3 to 5 days where 30, 40, 50, 60% of the year's gains are made. So we've sort of stuck to that. We're an extremely strong tailwind as an asset class. We know if we're in the asset class and we make sensible allocation decisions, we can win and make outsized returns. Will we try and smooth volatility through that? Well, that kind of undoes the first point, right? Like if we don't get the trading right, and getting the actual trading days right is much harder than just getting in the right asset class. It's got the tailwinds behind it.
So many people don't understand this. They're desperate to dampen the volatility, but dampening the volatility risks you missing the upside volatility, and then you've screwed up the whole game.
Yeah, I think, and you would know through your history, like even the greatest traders can't get it right, are wrong a lot of the time, right? And if you're wrong those 3 or 4 days of the year or in a couple of years in a row, you'll substantially hurt your returns, probably more than moving in and out of the market. Now, I think the general problem a lot of investors have, even at a retail level up to the largest hedge fund managers, to fiddle around, right? Because you feel as if you've got to do something. We try to sort of step back as much as we can, try to step back from that and sort of make that sort of decision and stick to that decision, no matter what the sort of intraday moves do. And it is very tempting to sort of play around and mess around from time to time, but we try to stick to picking the right asset. That's where we're going to generate the alpha, being the right assets that can make it through these sorts of cycles and deliver the outsized returns over sort of 3 to 5 year view.
It's interesting. I have hourly charts open next to me. Yeah, I never trade. But so I can kind of mentally trade to fight that urge, but I just don't trade. I kind of lock it away on my ledger so I can't do anything to it because you're your own worst enemy in this kind of stuff. I mean, a friend of ours who I won't name, but we both know very well, a legendary hedge fund manager. He's like, he's one of the best traders of all time. He's like, I just refuse to trade this because it's very hard to trade. And there's a lot of 22-year-old kids on Twitter who think they're genius traders at it, but it's so hard to trade. And my guess, if you look back and look at their returns over a couple of cycles, they're unlikely to be as good as just a buy and hold.
Yeah, I think and look, you find it from the the greatest hedge fund and prop traders at investment banks. The amount of people that think they're a great trader is quite a big population. The amount of people that are a great trader is a pretty small population. And then even those great traders would admit that, they're wrong a lot of the time. And, you look at crypto, look at who's made some of the most substantial returns. And if you look at sort of, interesting sort of topic at this point in time, the Mt. Gox distribution, like you look at the monstrous returns that people getting coins back from that process have made just because they had no access to their Bitcoin for what is it? Almost coming up on 10 years now.
Did they get the full returns back?
No, the ones that the people that opted to get coins back, some of the substantial returns they're going to make, right? Just because they've had no ability to trade, like you're saying, putting your ledger in a vault, making that vault hard to access is sometimes the best investment decision you can make in crypto. Now we try to bring that patience to the way we invest. We're a little bit more active, of course, because we're moving down the stack a little bit where things can go wrong or things can go right in shorter time frames. And you've also got to make sure that part of crypto is that emotion. Part of that is those new trends, is that new technology that comes around. So you need to live and breathe it day to day to make sure you're not missing those sorts of things and you're across that. But it's getting that balance right of living that sort of day by day, keeping up with the Kardashians type sort of atmosphere in crypto, but then not letting it overtake your sort of trigger finger on the buy and sell button.
So, as a disclosure, Exponential Age Asset Management, XPAM, is an investor in your funds. So, just so everybody knows that. But what I want to understand is, why is the hedge fund industry still so small? I mean, you're one of the biggest funds. There's a few others bigger, Alan Howard and a few others, but there's not. And the others tend to have a lot more mix of VC and other stuff in their assets. Why is it so small as an industry compared to the kind of 2.5 trillion asset class it is? Why is that? Because it feels like it's a place where you need professional capital to manage the kind of other stuff. Yes, sure, we can all hold Bitcoin and a few tokens, but when it comes to navigating what's the next big thing, it's not bloody easy. Why is that?
Yeah, I think it's a number of factors, both to do with the way the capital's allocated from traditional institutional investors, and partly to do with crypto as well. So if we step back, if you look at the allocation of capital, it's vastly gone to VC funds in crypto. So if you look over sort of 2022, there's about sort of $50 to $60 billion went to crypto VC. Now, why did that happen? If you step back, firstly, there's been some incredible returns in crypto. And we run an early stage crypto fund as well, and there's been some insane returns in that category, eye-watering type returns that most people would have never seen in their life, right? So you've seen those returns attract capital. The second thing is VC funds are closed-end funds. Closed-end funds don't mark to market every day like a liquid fund, or every month like a liquid fund, or even every quarter.
Yeah, it's basically like locking away your ledger, really.
Yeah, it's the equivalent from an allocator's perspective of locking away your ledger. You're giving capital to a space. You're not getting a month by month decision to make on whether you withdraw that capital, increase that capital. You're not getting that month by month volatility, which you've got to report back to an investment committee. You're effectively making a 5 to 10 year investment decision, and you get reporting based on that investment decision as opposed from a month to month. And that sort of fits, I think, with the mindset, particularly given the volatility of crypto, with the mindset of a lot of the way capital's allocated these days. Most allocators don't want 30, 40% month-on-month changes in the way in the funds they invest in. And realistically, that's what liquid crypto can give you through certain parts of the cycle. And the other point is, VC crypto fits within a VC sleeve within a traditional allocation. It's really just a different...
It can be a tech allocation, right?
Yeah, it's a different tech within an already existing team that's allocating capital to VC. Whereas liquid's not. It's a new tech, but it's liquid, so it sort of fits within hedge funds, but it has VC type returns, but then it has volatility like nothing else that they've got in their portfolio. So we've seen both the returns and I think the fact that it fits neatly within an existing sort of bucket within an allocator's zones, and it's got low volatility. And if you're an agent allocating capital, you don't want to allocate capital and the next 5 days it's down 30% in the first 5 days or whatever it may be. Whereas that's not going to happen if you're in a closed-end fund that's got sort of 5 to 10 year view. So 5 to 10 year reports on that basis. So we've seen outsized allocations go to that space versus the liquid market and liquid funds where you've seen probably 20 to 30 billion of capital go over that same period. But a lot of that capital's then gone to market neutral and long short funds, which aren't providing the same kind of, buy-in of that VC capital as well.
Hey everyone, listen, if you want to unfuck your future, let me help you. Follow this channel, subscribe, click the notifications, and you'll get everything as soon as it comes out. See you there. What do you think? My hunch is that liquid market returns over the 10-year time horizon will beat VC returns because there's so little capital in the space.
Yeah, well, I think, how does this get fixed? So, the way it gets fixed is either more people start to allocate to liquid funds that start to buy more of those sort of coins and tokens as they come to market, or you see price readjustments. And that's probably partly the second one seems to be leading the way as we go through things now. We're starting to see some of the more elevated capital raising valuations we've seen in VC market just not get met by the liquid market. The retail investors have moved down to meme coin land for the time being, where they can see a more sort of a more honest kind of exponential bet where they can make it against a sort of a fixed supply meme coin market. And you've seen a lot of those new tokens that have come to market had that sort of graph that we're unfortunately all too familiar with, where they launch at a very small float, very elevated, fully diluted valuation, and then trend down over a short period of time. There's just not the buyers or the capital to support those sorts of valuations. And so we're in that sort of period now, particularly it's been exacerbated even more over the last 24 hours, where we start to see a lot of those projects and even some of the higher quality projects start to trade down below their sort of their last private capital raise. And so you start to see the listed market starting to buy some of these assets at discounts to what that VC market paid. And that's where you start to see, I think, that kind of that distribution of capital start to play out as you start to see those sort of valuations rejig to sort of match the capital basis that they're faced with.
My hunch is if you under allocate to secondary markets, the secondary market opportunities tend to be bigger versus the cryptos. So it's the VC, because VC's over allocated. So everything goes to high valuations quickly. It then falls into secondary. The secondary traders wait. They buy these things at a discount when the market's at the right moment. And you tend, I think, to get better returns. My view is the liquid will probably do better than VC for now until this structural shift changes. The only other big players in the markets, I don't know if you see it much, is because we don't have that much professional capital. So there's a bunch of hedge funds, and the number of large hedge funds with anything over 200 million is, there's like 10. I mean, there's not that many, particularly directional ones, is the Asian trading groups. Those are often kind of murky private pools of capital. And they seem to be the ones who move size around. Do you see that? I mean, they seem to be the main traders plus a couple of the market making firms. I mean, I think Jump's leaving the market, but there's Jane Street and there's a few others. How do you see those other players?
Well, I think, if we look through, and this is why each period in crypto can be different. If we step back to the last sort of cycle we went through, you would see a much more kind of flow of capital from the majors to the altcoin space. And that would be a material mover of a lot of these sort of, outside the top 10 coins. I think this cycle, the difference is that capital's gone straight to the meme coin space and kind of jumped over what would have been the traditional kind of let's step down from the majors to find a higher growth opportunity. That's gone to the frogs and dogs coins as opposed to the DeFi and AI coins in this cycle. So that's probably something that's changed from a structural perspective in the market. Well, I wouldn't say structural, cyclical at this point in time. It's changed in the market over the last few years.
And that puts the advantage back to retail, right?
It does. As long as
you trade some of them, and most of the hedge funds trade some, but it's a small allocation to kind of understand market structure and that kind of stuff.
Yeah, and I think you need to be across that. And then a lot of the tech that comes out of that, like trading bots and those sorts of things, can be pretty relevant for the way we allocate capital and play some of that growth. So then it brings you back to the more traditional investors. And of course, I completely agree with your view that longer term, those liquid returns can be very high when you're buying those sorts of assets, because, there's nothing better than buying a high quality asset at a cheap valuation at a material discount to what the last VC round was at. And you've got liquidity, right? That's just discount upon discount upon discount. Now, the one caveat I would put on that is the market can stay inefficient for a long period of time, Raoul. So there's patience, right? You need to have patience. And as I mentioned, kind of when we started this discussion, that's what's in short supply in crypto. And that's something that we sort of make sure that we continue to keep up, the patience to buy those assets when they are at that discounted level, but then the patience to hold them until the market works that out.
Now, one of the things that I thought has kept the lids on the market for the last 3-6 months, since it peaked out in March, was there's just an enormous redistribution of tokens out of old hands from the last couple of cycles into newer hands. So as you mentioned, there's Mt. Gox is one. So that was a long time ago, but they're finally coming to market. The FTX estate, that whole bunch of stuff had to get sold, took liquidity out because a bunch of hedge funds and family offices took up the liquidity, but it still takes liquidity out of the market. We've had the Germans selling distribution. We've had Jump liquidating a portfolio. We've had a bunch of token unlocks from these things. Plus new supply coming and tens of thousands of meme coins. And it feels like there was not enough liquidity. So the market, I think, has done pretty well absorbing that by trading very sloppy sideways in the majors. Sure, the olds get crushed because they're getting replaced with these other things. How do you think about that kind of structure going on?
Yeah, I think I'd add the Bitcoin ETF and now more recently the Ethereum one.
And the unwinding of the grayscale as well.
Well, I think the Bitcoin ETF in a way is definitely sucked capital out of the rest of the crypto market. Right? So if you look at, we speaking to our LPs, speaking to our prospective LPs, speaking to my peer group, I think there is a bunch of capital that would have come more broadly across the market over the last 12 months that hasn't, because the ETFs become a simpler, easier sort of first step solution for a bunch of family offices and institutional allocators. And so I think there's a lot of capital in those Bitcoin ETFs that probably would have come more broadly across the crypto space if that ETF wasn't there. Now, longer term, I still think the ETFs are an incredible positive thing for the crypto market, but we have been in that sort of short-term window where I think they have been, on top of the other factors you've mentioned, have taken some capital out of the broader crypto market and partly driven sort of the outperformance or the extended outperformance we've seen from Bitcoin through the last sort of 18 months. Yeah, so I think that's one of the other factors that we've seen at play there that sort of changed the market dynamic from what we've seen the last few years. Now, I think, at some point that plays out. There's only so high Bitcoin and now Ethereum and those sorts of valuation can get versus the rest of the space before you see those sorts of valuation gaps close. But again, I come back to my other point, that takes patience. I mean, we look at the altcoin space and in particular some of the sort of key DeFi coins, and there's an index of about the 12 kind of core DeFi apps that have been around since since 2020, 2021, and so they have a good track record of generating users and revenue. We look at that subset that covers all sorts of that sort of DeFi activity. We look at their revenue generation. So this is revenue that could go to token, or fee generation that could go to token holders. they've grown that by 4 to 5x from that FTX collapse. So from the bottom of the market in 2022. So they've grown daily users, they've grown revenue sort of 400 or 500% or 4 or 5x from that period. Over that same period, and adjusting it for what's happened in the last 24 hours, their prices are flat, right? So you've seen the fundamental side of the sort of the non-Bitcoin crypto sphere actually do keep up its end of the bargain. They've generated the users, they've generated incredible revenue growth, and these numbers are getting pretty close to all-time highs, right? We're getting close to 2021 peaks in terms of that fee generation. Token price has done nothing. Now, should the token price have matched that revenue growth to a degree? Well, you're going to have, to use a TradFi term, multiple sort of recalculations in that as well. But from all the metrics we look at, from a fundamental perspective, crypto market's healthy across the whole sphere. It's attracting users. It's generating the revenue. The token prices lag, but at some point that's kind of got to give. When you're getting tokens that are doing buybacks of 25% of their tokens in a year or paying cash yields of 20+%, there's only so long that those sorts of things can be sustained before people start to see that sort of value.
One of the things there was, Kobe on Twitter, one of the things he mentioned was, and that made me stop and think, he's like, well, I don't think the altcoin bear market has finished yet. And if you go back and look at 2017, alts didn't bottom until, 2016 the market bottomed, but 2017 alts bottomed. So a year later, so the equivalent of 2025 this year. Also in 2020, the same thing. They bottomed later after Bitcoin. So maybe there's a delay in alts versus Bitcoin by maybe 12 months. And maybe that is something we haven't kind of factored in.
Yeah, if we look at 2019, 2020, you had some kind of false starts where you had some kind of initial layer ones come to the market sort of through 2019, early 2020. They got some pretty substantial kind of market upticks and some of that sort of petered out. I think the thing that really sort of drove the altcoin space, and it comes back to the fundamental point I was just making, was really the launch of DeFi at scale, where they started to see, we saw Compound come to market, you saw Aave and other players come to market, start to use tokens to bootstrap a protocol, start to see quite enormous sort of growth amongst users and TVL, and start to see some sort of real fundamental growth. And that starts to drag capital away from the luxury of just sitting in majors and trying to get beta into this sort of higher growth sphere. And I think that's what gets the altcoin market going. It's got to, we try not to be too passive in thinking about what can drive prices in the altcoin market. It's not just Bitcoin's gone up a lot, I'm going to allocate to altcoins. Altcoins, they're a smaller, higher risk, less liquid investment. They need to demand that investment. So they need to actually perform to grab that capital. And we saw that in DeFi summer, as it's affectionately known, back in 2020, as they started to see huge user growth out of kind of zero, right? You started going from sort of 4 users to 10,000 users to 50,000 users over a few weeks. And that starts to demand investment as opposed to just a passive reallocation. And I think that's what gets altcoins going. They need to demand that investment. Now, I think the difference we're kind of seeing this time in the way we're starting to see that from a financial perspective, they're starting to demand investments just given some of the metrics that are on offer for some of these more mature protocols that have been around in the market for sort of 4 or so years.
Also, if you speak to younger people in this space, the more Bitcoin goes up and the more you see this lag of alts, the more they say, well, what's the point of owning Bitcoin, Ethereum, Solana? I can't make the returns. Because they're a 32-year-old, they've got $10,000 saved up. They're like, a 3 or 4x in Bitcoin just doesn't move the dial for me. I can't buy a house. I can't do anything. I mean, you and I talked about this a bit in Australia. It's like they're forced out the risk curve, which is why memes have been so big. But once alts start to move, it feels like that capital gets recycled into those.
Yeah, I think that's the difference this time around. Like traditionally, we would have seen with the strong Bitcoin runs, we would have seen DeFi or, for this cycle, AI coins or whatever it may be, attract a lot of that capital looking for that sort of higher risk, higher return. To date, to your point, it's gone down in that meme coin space where you can get that 5 or 6x in a few days. Now that comes with all sorts of other risks and all sorts of things that everyone's going to be aware of. But that has been one of the differences this time. That's attracted a pretty substantial amount of capital. Now, the one thing I would say is, as you've started to see that get more attention, as you've started to see more kind of celebrity coins and those sorts of things, I think that runway in that meme coin space, where it was pretty open to some good traders that made some sensational returns, and credit to them for taking that risk and sort of taking on that market and getting that sort of short-term specialized skill to pick those sorts of coins that differentiate. We're starting to see that sort of slant a little way against those investors, though, as you start to see more sort of insiders returns coming to that market. So our view would be you start to see some of the returns come out of that. You start to see retail investors looking for probably a little bit more lower risk, a little bit more sort of something that's a little bit more tangible that is not so tilted against them as that meme coin market seems to be trending towards at the moment.
Yeah, and don't forget, it was a year ago much easier. There was Bonk, there was like 10, new meme coins. There was the old ones from the old cycle, and then suddenly Pump.Fun comes, and there's fucking 10,000 a day being launched, right? And then it becomes impossible.
It's good for Solana, of course.
Great for Solana, but this is an attention economy game, right? And there's a fixed amount of attention. Yes, the space is growing, but right now we still don't have that many new entrants into the physical coin space versus ETFs. So the more coins you give, the harder it is to focus attention, so the harder it is to capture value. When there's very few and people go, oh, this is a fun idea, they all do well. So, you're trying to divide attention, which is a finite resource, only driven by the number of new people in the space. Or people.
Yeah, you get the anomaly like in the meme coin space where you get stuck getting sniper bots, and it goes from owning the right meme coin to owning it first and getting out of it almost instantly, right? So you create sort of micro attention periods, even as a sort of another layer on top of that. I think you do get that sort of that velocity in that space that people sort of crave in crypto that they've traditionally wanted from the altcoin space. But to your point, you're starting to see that oversupply. And to be honest, that's a bunch of the story we're starting to see in the altcoin space as well. We've already spoken about what I'd say is the under allocation into the liquid space versus the VC space, which has driven that VC coins and tokens come to the listed market at some point in time. And so when you've got a $60 billion market trying to sell into a market where you've got $10 to $20 billion of allocated capital, and a lot of that isn't even net long, you can start to see what's going to happen, right? And so you're seeing the same dynamic play out even in the altcoin space as the meme coin space. And there's just too many alts for too little capital. Now, as I mentioned, there's two ways that gets fixed. You allocate more capital to that space, or that space gets vastly revalued. That's like new coins coming out. And that's what we've probably seen over the last sort of 12 months or so. We've seen a dramatic revaluation in Bitcoin in some of the majors, and we've seen the alts, that oversupply, push the value of alts down. And we're starting to see levels now where we're starting to see that sort of fundamental value come through.
Yeah, because, there is a limit to the number of layer twos. Because, what's the difference between one to the other? It's, we're starting to see that narrative coming. At first, people were like, well, let's see how these layer twos are going to be valued, etc. The first round, Matic and stuff from last cycle did pretty well. And then they've just been nuked to death because these are kind of infinitely replicable things, right?
Yeah, and I think it needs to, the markets fix them or heal themselves through all sorts of different phases. And it means that, VCs will start to make a lot less money and start to lose money on the next layer 2 or the next layer 1 that they invest in. And so you start to see the whole sort of structural shift in the market. Because I think to date in crypto, the big returns in the VC space, which, we've been fortunate to participate in as well, have been in picking those right layer ones, like picking that Solana, picking that Avalanche, that VC type round where you get those sort of 100x type returns. And that playbook's played out probably longer than most people expected, but I think we're starting to see that unwind now. So you start to see the valuations come down in the liquid market for that next layer 2 and start to come down below the levels that VC markets have funded them at. And so you start to see less funding of those things happen and the markets sort of heal themselves. But it does take time.
Also, I thought it was very interesting what Coinbase did by launching Base, which is a layer 2 with no token. And that kind of made sense to me in some respects, is some of these things don't need tokens.
No, and we're starting to see people sort of reinvent the way these tokens are launched. You know, if you look back at the broad crypto environment that probably generated the broadest spread of returns, you know, of retail versus insiders, was back in the ICO craze of 2017. Now, that had a whole bunch of other issues around legal risks and disclosures, and I'm not stepping back from that. But if you looked at it, that was probably the most even playing field in capital markets across any asset class we've seen for a long period of time, right? Like, as crazy as it was, you know, retail investors were making huge returns, and the returns they were making versus the insiders in that market were probably the most balanced we've seen in the crypto market to date, right? And now that's gone away for a whole bunch of different reasons, but oddly enough, that sort of drove a much more balanced market where people were investing in the liquid market because there was still a lot of valuation upside left on the table from those ICO launches. And in a weird way, it had got to a place in a very short space of time that the IPO market, you know, where I spent a bunch of my time as well, has got to over 50 years in the equities, right? You don't list an IPO, and IPOs don't price at their maximum price. They price at a fair price to leave something on the table for secondary market investors. So initial investors make money. Secondary market investors who take that risk on day one, day two in an IPO generally make money as well. And that's a much more conducive capital market to what we're seeing in crypto lately, where either the insiders make way too much money or the listed market wastes way too much money. And it's just getting that balance right. So I think what we're starting to see is teams, more sophisticated teams, think about how do I approach the crypto market and the funding market in a more balanced way that avoids some of the pitfalls we've seen over the last few years. And so we're starting to see what we think is a trend towards more of a fair launch type approach. You know, something that's just really interesting that we're following at the moment is, you know, the Arweave team launching their protocol AO, where it's a completely fair launch. The team don't have any tokens. No insiders have any tokens. You effectively have to farm that token by giving either owning Arweave and getting access to the token or staking your ETH. So you stake your ETH to a contract. You earn AO tokens for doing that. And the team gets to keep the staking rewards to effectively fund the development. And anyone can access that contract. Anyone can effectively earn those AO tokens over the next 3 or 4 years in size by giving up the yield on their ETH to effectively earn them. And it's a fair launch. It's open to anyone with, you know, half an ETH to 10,000 ETH. And, you know, the team even starts with none, right? So you start to get that sort of fair, open access allocation to anyone that wants to take the opportunity to get involved in the ecosystem and turn up. And so when that protocol launches, you're not going to have this capital that's got in a much lower price into the prices and is looking to exit. That's got different sort of a different sort of risk return profile that people buying in the secondary market.
Yeah, and people try to get around this whole concept by airdrops and kind of points, but it still disadvantaged everybody, and it just also felt like what you did was rent attention, and you didn't bootstrap most of the networks who did it. People just went there, got the airdrop, dumped it as fast as they could, did exactly what they accuse the VCs of doing, which most of the VCs actually don't because they're usually locked up. But they'd farm this stuff, figure out how to get the airdrop, dump it, and move on to the next one. And it's like, well, that does not work either.
No, and then that starts to get gamed, right? So I think there's two things that make people committed to an investment longer term, which is what you want when you're building an asset, when you're building an ecosystem or a protocol. You want people alongside you that are committed. Now, there's two ways to be committed. It's either capital or time, capital and over time, right? Now, I think that the problem the airdrops faced was that it made people committed, but over a very short period of time. And so attention just moved to the new thing as soon as an airdrop passed. And you effectively gave away substantial quantities or ownership of an asset to people that were only there for a few weeks in time. Now, when you're building something and you're a team and you've got tokens and you've got skin in the game over a 5-year plus time frame, that kind of doesn't make a bunch of sense. So what I think we'll start to see is things where you're making that commitment to an ecosystem over time, like staking capital and giving a return or giving up a return over a longer period of time to earn those tokens over a longer period of time. And so you start to get alignment between the investors and the team and the ecosystem that's building over that longer period. And look, this isn't rocket science. This is how traditional markets have worked, right? VCs make investments in traditional markets over 5 to 10 year time frames. They go through the good and the bad of building things from the ground up. And that's traditional markets have worked out that's the best way to get alignment with capital and builders. And the crypto market will get there over time, and it's starting to get there now.
And the other thing is, as you mentioned, because of this misalignment between tokens that have a lot of VC investors that come to market or have token overhangs from unlocks, they tend to get really quite cheap. At this point in the cycle, you've got this hugely stretched relationship. And for me, I think the big game that I'm looking at is usually there's a chosen group of four, the four horsemen, the ones that get chosen for the next cycle. If you remember last cycle, it was Avalanche, Polygon, Luna, Solana. They were that was the big race where there's huge gains because they got sold off. They were all like ETH was sold off as soon as it had its ICO as well. They came off like 70%. They kind of stabilized. And then as the market regime changed, the capital came in. I'm really eyeing I'm doing a lot of charts of one versus another, trying to figure out, okay, what is strong once you filter out market movements. But that feels like that's a big game. And it feels like it's probably a layer one game because they're bigger. Sure, there's going to be other stuff. We'll talk about the other stuff in a sec. But how do you see that layer one race? I mean, do you agree with that thesis? This is probably going to be another group. My current view is it's probably, and again, I don't know, don't really have an insight, but I'm guessing it's something like Avalanche. Even though it was last cycle token, they seem to be doing interesting stuff. Sui and Aptos, because they are a whole different kind of ecosystem, but all of these have this kind of high LDV, low float. I think Monad has not come to market yet. That's another one. Maybe Near. I don't know. What do you think is this race? And again, it's very early to pick it, so I'm not holding a gun to your head. But what's your hunch?
Yeah, I think we look at layer ones as we've always had a view that there's going to be a number of what we'd say is a multi-trillion-dollar layer one protocols. Now, how big that number is, I think is a harder thing to predict. But when you think, but they're going to offer different things, right? They're going to offer different opportunities.
I mean, they
different use
sell
cases.
They're just decentralized businesses that sell block space.
And so they need to have something that's unique about that block space.
That's right.
Either it's speed of transactions, it's security, whatever it may be, it's language on them, whatever it may be. So, we've always taken a view that there's going to be multi-trillion-dollar layer ones. They're all going to find some area where they have a comparative advantage. That comparative advantage is going to lead to more and more apps and use cases being built around that. And that's going to crowd out other use cases. And we've already seen that play out, I would suggest, between Ethereum and Solana. It's not it's not a coincidence that the pump.fund and all the meme coin activities happened on Solana versus Ethereum, because it's a fraction of the price to do that on Solana versus Ethereum. Now, that's not a bad thing for Solana, not a bad thing for Ethereum. It just means that Ethereum has become more valuable to people like us that are moving millions of dollars around in a transaction, right? And we're happier to pay the higher fees, although that's been addressed a little bit by layer twos, but we're happier to pay the higher fees for the security and that comes with Ethereum. But then that left the door open to someone like a Solana to grab that, initially that NFT marketplace and now that meme coin marketplace, where you've got that sort of rapid transaction speed and that launch capability to launch tokens at a minute fraction to what it was on Ethereum. And so Solana has grabbed that market from Ethereum. Now, that's not, that just plays into our thesis that there's not going to be a chain that's, everything to everyone. They're going to find this specialist use case. That use case is going to become successful. That's going to grab all that block space that you talk about and dominate that block space and create out other use cases. And those use cases will find another chain that suits the purpose that they want.
Yeah, and my view is this space is, $2 trillion today after the sell-off. And I think it goes to 100 trillion. That's just extrapolating out the log trend of adoption or just the market cap, total market cap chart, put it on a log scale, put a regression on it. It gets to 100 trillion by, let's say, 2032, 2034. So you can see the space is still player versus player a lot. They're like, oh my God, Solana's robbing Ethereum. It's not. The whole thing is going to explode. So as you say, there's plenty of space for 5, 6, 7 multi-trillion-dollar ecosystems.
Yeah, we've never adopted the Ethereum killer or Bitcoin killer type approach to anything, because I just think it's the wrong mindset. We have exactly the same view as you, that this asset class is growing way beyond anything it's at today, which means that rising tide can float all boats. It means that Solana and Ethereum can definitely win together. It doesn't mean the player versus player is the interesting thing, and to a degree that actually plays in the favor of crypto around that whole ecosystem building, having people that are passionately focused on one asset or one ecosystem actually is advantageous to that ecosystem. But from a purely financial perspective, it doesn't mean one fails and the other prospers, because I just think this space is too big to be catered for by one protocol. I mean, we're starting to see a whole bunch of consumer apps start to come to market, start to get that sort of traction that we haven't seen previously in crypto. And that opens a new opportunity for new layer ones. We're a sizable investment across our firm in Year, for example, which is starting to see real sort of uptick on that consumer app level that we haven't seen in crypto before. And that's a new market that we think a layer one can grab, that some of the players like a Solana or Ethereum don't have, or probably won't grab at this moment, given the use cases they're chasing. So you see new opportunities come along, and you see new protocols like a Near or a Telegram or a Ton open network start to grab those opportunities. And that doesn't mean that takes growth away from Solana or Ethereum at all. It just means that you're broadening the market. And I think as investors in crypto, and as in people that also passionately want crypto to succeed and blockchain technology to get to where we want it to get to, that's what you want to see. You want to see a broad-based growth across multiple protocols and across multiple apps that have different use cases.
So any other layer ones that are on your radar screen that might participate? You talked about Ton, you've talked about Near. Anything else that's kind of on your radar screen?
Yeah, outside of the I guess the recognized majors, they're the two biggest investments that we've got at this point in time. They're the ones that we think bring something differentiated to crypto outside of the Solana and Ethereum. Telegram is a unique approach in crypto. Cryptos generally build the tech and they will come type approach, right? And it's something like Ethereum has been incredibly successful at doing that. But that's a very different approach to Telegram, where you've got this billion plus user ecosystem with a chain now getting introduced to that. So it's the other way around, right? Like let's grab the users from an existing ecosystem onto a protocol, which is something that crypto hasn't had before, given the amount of bootstrapping that's gone into the tech to date. And we think that's a super interesting opportunity. We also think with the way a lot of the consumer apps are going, and even the way a lot of the trading apps are going, the things like Banana Gum Bot and Unibot and some of those other trading bots, which are pretty incredible technology, you're starting to see that sort of crossover between Web 2 consumer apps like a Telegram into the crypto sphere. And you're starting to see a much more seamless user experience around that whole, let's get users across to crypto without having to interact with the ledger that's in the vault that you talk about, right? Start to get those clicks down to a more Web 2 type basis, start to reduce that friction, which has been one of the key issues I think that crypto's had in terms of getting those new users onto platforms. And we're starting to see things like Telegram and things like some of the consumer apps starting to sort of abstract away that crypto thing and that crypto part, traditional crypto part of the equation, and use crypto what it's good for: processing transactions, providing security, moving value at high speed. But let's make a Web 2 interface, or let's use an existing Web 2 interface to bring that that usability to a whole new user class of people, and that's how you get to the billions of users as opposed to the millions and tens of millions.
The other one that I thought was a great breakthrough for the industry was Polymarket. It's just a beautiful application that nobody knows really or cares that it's on blockchain, and it works exactly as it should, and it's captured the world's attention, and people don't even know it's crypto.
Yeah, I think that's what we get most excited about when people are starting to use applications solely for their utility. And it's got nothing to do with it having anything to do with crypto or anything to do with an underlying coin or whatever it may be. They're using it because it delivers more utility than the Web 2 version that they've been using. And so things like Polymarket, which prospers because of the utility it offers, got nothing to do with the fact that it's using crypto. It's kind of like the holy grail, right, of what we want to see. There's an investment we've got on the VC side in a small messaging app called Session, which has over 1 million users today, growing at sort of getting 100,000 downloads a week out of the app stores, and 80% plus of the users have no idea that it has anything to do with crypto. It offers a messaging app that's just got far better security because it uses a decentralized network to deliver those messages. So it's effectively completely private and untraceable. And so it's offering a solution better than an open source solution like Signal with better security, with functionality that's up there with Web 2 functionality. And you don't have to know anything about crypto to use the app. You download it from an app store just like you download Signal, and you can use it just like you can use Signal. And it's using Web 3 to deliver the security benefit that you can't get in a Web 3 environment. And that's what we need to see, more apps like that sort of have Web 3 under the hood and deliver the benefits of Web 3 without making users go through a whole new gates to sort of get that utility.
So on the VC side, are you seeing less deep tech and more application stuff, or is it still more tech infrastructure and still less applications? Because we're kind of waiting for this applications layer.
Yeah, I think we're starting to see a little bit more on the application layer. I think we're starting to see that cycle play out, like I mentioned earlier, because the returns from sort of deep tech are rapidly reducing, right? And so the VC market starts to get more sensible about how they allocate capital. The next, creating a layer 3 or a layer 4 isn't the easy money that people started to think that it was, right? And so you start to see over time returns force that capital to look for investments that offer better risk rewards. And we see that more in the application space, to be frank, on the VC side now, where we're starting to see apps, like the ones I mentioned, where they're starting to get sort of tens of thousands, hundreds of thousands, millions of users trading at material or raising capital at vastly discounted valuations versus anything in the protocol space. So from our perspective, that looks like a much better risk reward bet for us on the VC side. Now, we're not seeing as much of it as we'd hoped to see at this point, but I think that's driven by success. We just need a few of these apps to get the sort of the returns to the investors and the founders that we think they'll get over the next 1 to 2 years. And then that drives part of that allocation, and part of those founders to focus more on those apps and get that sort of success. And it only takes, you see it in crypto all the time, right? Like you see one DeFi app like Compound suddenly bootstrap users out of nowhere, and it drives a whole sort of vertical in the space. It only takes one of those success. You see something like an Axie come out of nowhere with users from sort of 0 to gazillions overnight, and it drives the whole sort of gaming allocation, both at a VC and a liquid space. So you just need those success stories, I think, to sort of show that what can be achieved, and capital follows.
I think one of the things that I follow from people that I know is I think there are some very big game launches coming. I think Off the Grid is the first one that's probably this month, which these are kind of AAA, ultra good games. And that becomes, if anybody has a breakout in that, that's very interesting, because obviously the size of the number of users for a big game, it's not an easy game in itself to launch games. It's a pretty difficult thing. But if you get it right, somebody's going to really bootstrap a network unbelievably on this.
Yeah, I think you basically got people taking two approaches, right? Like it's take the traditional approach of building a game that's competing with a Web 2 game today, but uses crypto for that sort of value transfer or functionality that you can't get in the walled garden approach of most Web 2 games today. And I think that's super interesting. And like you, we're waiting to see the game that kind of sort of cracks that nut. And that's that's where a lot of the capital's gone in the VC space when you look over the last 2 to 3 years. So we'd expect some big winners to come out of that. But, like developing games in a Web2 space or movies, when you step further back, picking the winners is hard. One of my earliest memories from banking days is listening to our analyst who was covering News Corp at the time come in and give the download to the morning meeting about what a massive flop News Corp had wasted billions of dollars on called Titanic. And how this movie, he'd just been to the pre-screening as one of the analysts, was going to be the biggest failure in movie history, right? And it ended up being a massive money spinner. And, really smart guy, sophisticated guy covering, he was a top-rated media analyst at the time, but it just goes to show how hard it is to pick winners when you start to get into that kind of artistic type overlay into the investment space. I think one of the other interesting things is games that have taken the other approach, that have taken a much more crypto specific approach. Crazy things like combat hamsters and those sorts of things where you're getting hard to verify these numbers, but you're getting tens up to hundreds of millions of users that are coming at a much more crypto centric type approach. So I think we're starting to see two kind of valid options come here. One takes a more traditional approach and sort of bolts on crypto in the way that it can add utility to an existing avenue and vertical. The other one's taking a more traditional crypto sort of off the wall approach. Let's come up with a game where you got to click a screen to effectively earn something over time, and that's bootstrapping.
Yeah, but we're seeing those can be very fleeting, right? They're almost pay to play. You kind of do it, costs you money, you get a bunch of users, and they fuck off to something else. So it's kind of.
That's the challenge for the developers, right? Can they then develop that game into something that becomes more sticky? So you've got the audience, and as we know, getting the audience is generally the hard part. So can someone again crack that nut of, I've got these tens of millions of users from clicking a screen. Can the second iteration of this game now hold them?
Yeah.
And someone will get that right as well, right? Someone will get that next iteration of that game that'll become the next Candy Crush.
So what other sectors interest you right now? I know this might change, but what are you kind of focused on in other sectors, thinking there's opportunity?
Yeah, I think we started off as particularly looking a year or so back, pretty skeptical around AI and the crypto overlap. I think when we looked forward sort of 5 to 10 years, we could absolutely see that we could see the two coming together. I mean, you start to think about agents operating in a digital world. Agents aren't going to be sending SWIFT transfers, right? So it's natural that when you start to operate, at an autonomous level at digital speeds, that crypto is going to play a part in that. I think we became more skeptical when we started to see some of the shorter term sort of use cases on the radar around, the ones that could use, kind of more the models in AI space today, and overlay that with crypto, just given, the amount of capital in some of the traditional players and the amount of growth they were starting to see. I think where we got a little more excited is where we started to see two things happen. Firstly, the use cases and some of the entrepreneurs we talked to come up with more sort of tangible, shorter term use cases around AI that made sense to us. And we started to see, which I think was interesting on the traditional side, some pretty big missteps from some pretty big players. People like Google, we also are around their sort of their image generation and those sorts of things, starting to skew their AI down avenues that sort of started to show that there was a place for open source and verifiable type attributes to play in AI, where people could actually understand the model they were using and understand the output was coming from a model that they understood was unbiased or giving them results that they wanted to see. They wanted to see unfiltered. And I think we thought that use case would come over time. I think it's going to come faster than we thought, just given some of the missteps made from some of the traditional players, where in our view they've kind of shot themselves in the foot to a degree and opened the door for new players.
So just to summarize, because we've been talking for an hour already, I can't believe it. Where's the biggest position in your portfolio, knowing that it may change tomorrow or it may not or whatever? But where's your concentration of position? What are the names that that you're mainly focused on? Obviously, you look at a lot of stuff, but just the general direction.
Yeah, look, I think we've actually, our biggest position across the firm is in Solana, and we've done that. Basically, if you look across crypto at this point in time, growth and most points in time, growth is getting rewarded. Growth in users gets rewarded, and that's where Solana wins at this point, right? Fees and revenue and those sorts of things, we think ultimately will drive value longer term. But at this point, where we're at in the market, it's users that have been driving growth. And when we look across the chains,
very active users, and they're very active on Solana, right?
Yeah, and so the three of the bigger positions we've got across the firm are the three that have got the growth in daily users and monthly users. That's Solana, that's Near, and that's Telegram, and that's what the market at this point rewards. So when we spoke about earlier around those sort of 10 or 11 DeFi apps and how they've grown revenue by 3, 4, 5x, but their prices are basically flat. And, so revenue, TVL, those sorts of things aren't getting rewarded. What is generally getting rewarded is users. And that's the one metric that we follow that has been rewarded with price.
And that was, that when you go back to your TMT days, the early stage of the internet was the same. It was users first, and then eventually business model gets the reward in the end, wins the game.
Yeah, and I think that's, and so it makes sense that investors are allocating capital and rewarding that, given that they're the chains that have got momentum, and that's what people want. They want to see growing ecosystems. They want to see chains that are attracting that sort of triple digit user growth level. And there's a bunch of protocols out there that have reached all-time highs in their user levels, sort of month on month, as we sit here even in July, as prices are trading at a fraction of their all-time highs. So that's when value starts to emerge. So, three of the biggest positions we've got across the firm are Solana and Near and Telegram for that reason. They're the ones that have got user growth. Outside of that, new protocols coming to market. AO is one that we're excited about, and so we hold a bunch of Arweave to effectively get access to that. It's a fair launch. It's doing an approach that we think can see a token grow over time in a much more traditional, fair way, without that sort of VC dynamic and overhang that we've spoken about. And it's interesting tech focused on new use cases. And so we own Arweave to get that. And we also use some staked ETH to earn that as well over time. So that's also bigger positions. And AO will also use Arweave on the storage side. So we think it can drive that sort of high user growth, high functionality growth to Arweave. So we sort of win on both sides of that investment if it plays out the way we think it does over the next 12 months.
And are you thinking that we see price acceleration at some point relatively soon? Relatively soon meaning next 2 to 3 months, that we start to see, the more typical crypto price action for, that kind of election period, post-election period. How are you thinking about that in terms of structure of prices going forwards? Again, not talking about market timing, but just talk about overall structure.
Yeah, I think we look. There's a lot of factors.
Well, I didn't say the word banana zone, but you know what I meant.
Yeah, I think we look. I think the name of our game is to be patient, right? So, we remain supremely confident that you see a vast revaluation of the space over the medium term, whether that's 3 months, 6 months, 1 year. It's hard to predict. There's a lot of factors outside of crypto's control, right? You've got US presidential elections playing a big part in price direction of crypto now, more so than ever before, right? And that's clearly something that, apart from the money that crypto is giving, which does influence it to some degree, that's clearly something that's out of all of our control, right? But it's going to have a big influence on which way crypto trades. We're seeing things on the macro market, particularly the last 24 hours, which may change the sort of short-term liquidity profile materially, and that could sort of give crypto a jolt in one way or another that we can't sort of predict in the shorter term. I think where we take comfort is when when we see price moves like we've seen over the last 6 weeks and the last 24 hours, but the underlying things like user growth and TVL and fees generation is just trending in one direction only. And so at some point, as you know, markets generally get this stuff right over medium or longer term, so things need to fix. So, if we were seeing altcoins trade like we've seen them trade, or we were seeing DeFi trade like we've seen it trade over the last 12 months, but user counts looked anemic and all those sorts of things, then we'd be much more panicked than we are today. But we know longer term, these things markets get these things right over the longer term.
Brilliant. As ever, my friend, really good to talk to you. Let's see how it plays out. You've given me some stuff to think about this. I think there's something really strong in what you're saying is some of these alts have prices near their lows over the cycle, yet their user growth or other quality metrics are expanding. I think that's a really good thing for people to look at. Now, the problem is some of these kind of are gained in terms of user growth and stuff. So you need to do a bit of work on doing it. But I think there's something really big in that idea that becomes very interesting because this is very discounted versus, as you said, the VC markets and other stuff. Richard, fantastic to see you. And let's see how it all plays out.
Great. Thanks for having me. Good to speak again.
Yeah, great to see you.
Cheers.
So a fascinating conversation with Richard, as ever. We covered an enormous amount of ground. We got out of him what some of his favorite tokens are. We understand his thesis on Solana and where the space is going overall. I really like Richard's view which is basically my view, which is tomorrow is going to be more digital than today. So in which case the super trend continues and everything else is noise. Now, I also like the fact that he tends to be just a long-only investor and is looking for interesting opportunities as the market sometimes dislocate. I found it profoundly interesting when he's talking about some of these VC tokens that people don't like. That's the narrative. And now getting very discounted in the market. And I see that myself in many of these tokens. And you'll start to think, maybe that is interesting because maybe now that's been accounted for in the price and therefore there's big opportunities. So I, for one, am looking for the next big trade here, what the next big layer one is, and starting to look at this stuff that's got pretty discounted. When Solana's near the highs, many of these are near the lows. And it's like, okay, time to start doing some work. The good thing, the hedge funds will get them first. So XPAM should benefit from that. But, and obviously I'm an investor in that, so that helps. But I also am intellectually interested in the next big trade, which I think is coming. So lots to do there. Again, if you get a chance, do me a favor, sign up to Real Vision because I think you'll prefer the experience there. I know YouTube's easy for you, comes into your feed. But that, if you really want to dig in and become an expert and go on that journey from information to knowledge to wisdom, that's the place to do it. We built it for you, so go ahead and use it. Anyway, see you next time.
Make large crypto trades with Kraken OTC. Execute orders of more than 100,000 off the open exchange through our premium OTC trading service. Get 24/7 access to deep liquidity, minimal slippage, and competitive execution and settlement services. Private and secure trading options include chatting securely with our trade desk for a personalized high-touch service, or use our self-service RFQ for super fast, automated OTC trading. Non-investment advice. Crypto trading involves risk of loss and is offered to U.S. customers through Payward Interactive Inc. For more information, go to realvision.com/Kraken OTC.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.